Hello ladies and gentlemen, welcome back to Dre's YouTube channel. Today we'll be going over the different phases of the stock market, and if you stick around to the end, I will show you one key rule of thumb that all investors must know when buying and selling stocks. Alright ladies and gentlemen, we'll now transition to my iPad where I have the Yahoo Finance application pulled up. We are going to type in ticker symbol SPX. This is the ticker symbol for the S&P 500 index, and we will use this ticker symbol to show an example of the different phases of the stock market. So we're going to bring this up to a full screen, and I have the 1-day chart pulled up. I'll just click on the 5-year. Okay, so that was the 5-year pulled up. You see at the bottom left, we have from 2019 all the way to present day, which is November 23rd of 2023. Happy Thanksgiving, by the way. So taking a look at this chart, first, before we begin, the different phases of the stock market. So technically, there are 3 different phases of the stock market. You have the accumulation phase, the participation phase, and the distribution phase. However, the participation phase takes place twice in a full cycle of the stock market. So with that being said, it is technically 4 different stages of the stock market. Ladies and gentlemen, we will now look at a snapshot of the S&P 500 index where you can see each phase of the stock market taking place within a 4-year period. Keep in mind that a full cycle will begin at the accumulation phase, but moving from the left to the right, the participation markup phase, normally stage 2, takes place when large banks and institutions as well as retailers are buying into the market. At the peak of the rally, the distribution phase takes place. This is when investors are taking profit, especially the smart investors that bought during the accumulation phase. But more importantly, this is when a trend reversal is preparing, which leads us to the participation markdown phase, which is the final stage of the stock market cycle. This is when the late investors to the party that bought during the distribution phase is stuck holding the bag because the early investors took profit by selling to them once the market met its highs. This is why it's very important to understand market cycles, because you don't want to be the person caught holding the bag. And as you can see, the accumulation phase will once again begin once the bottom of the sell-off is found and big banks and institutions begin moving the big money back into the stocks. All right, so if you've stuck around for this long, then I will now show you a rule of thumb that this is a general rule of thumb that investors use when it comes to buying and selling stocks. So from the same Yahoo Finance application, we will click on this indicators, and this is completely free to everybody. You could just download the Yahoo app from your phone, or you can go to yahoo.com and you still have access to these free tools. So we will click on this indicators, and what we want to pull up is the moving average. And for this period, this is the time period, we want to pull up the 200-day moving average, and we would make this color red so it's very noticeable to us, and we will add this to our chart. All right, now that we have the 200-day moving average added to our chart, I just want to highlight that the 200-day moving average, whenever we are trading above that moving average, we are expected to continue to rally in the stock market. And whenever we trade below the 200-day moving average, the stock market is then selling off. So we'll just scroll over to the left, and you can see that going back years, this 200-day moving average has, whenever we come down to it, we will find support and we will bounce right back up. However, if you go back far enough, you see that from 2010 or from 2008 to 2010, we traded under the 200-day moving average, which, as you know, that was a vital time in our history as far as with the housing market crash, the Big Short. So if you go back far enough, you see that it is times that we trade under this 200-day moving average. So with that being said, coming back to today's time, coming back to today's time, you see that we've been above this 200-day moving average since 2011. So with that being said, right now, the rally that we're in, don't feel pressured to rush into it, because if it's true that history repeats itself, you know that at one point in time, we are coming back down to this 200-day moving average. However, keep in mind, the 200-day moving average moves with the stock. So if the stock is going up, the 200-day moving average is also increasing. Same way if the stock is going down, a 200-day moving average is also decreasing. What is the 200-day moving average? The 200-day moving average is an average calculation of any given stock's last 200 days. What it does is it takes the closing price of a stock for the last 200 days, adds them all together, divides it by 200, and it gives you an average price. Thank you guys for tuning in with me. Please don't forget to like and subscribe. Also, if you have any questions about anything that we went over today, feel free to leave them in a comment. I will be sure to get back with you in the comments. Remember, friends and family, I am just here to share my ingredients. It is up to you to create your own recipe to financial freedom. Don't forget to like and subscribe. Thank you.